Hello, everybody, and welcome. This is exercise 7-20 and 7-21. So I'm not going to focus on the AR turnover, and I'm also not going to be doing this part C, but I am going to do these journal entries because I do want to look at exercise 7-21. So journal entries to record the items. So right over here for exercise 7-20, what I'm going to do here is my net sales on account were 100,000. So I'm going to debit accounts receivable, credit sales. And this is going to be during, I don't know, let's say it's like 20x1. We'll just call this number 1. And then to record sales E720. And then to show the collections on accounts receivable. Okay. Okay. So I've done the journal entries to record the items noted above. Now, use the information for Jones Company as presented in exercise 7-20. Jones is planning to factor some accounts receivable at the end of the year. Accounts totaling $25,000 will be transferred to credit factors with recourse. Credit factors will retain 5% of the balance for probable adjustments and assesses a finance charge of 4%. The fair value of the recourse obligation is $1,200. Now, when we do a sale with recourse, okay, so the way I'm going to do this is I'm going to be receiving cash, and I'm going to need to take the accounts receivable off my books. But there's going to be some different things here. Okay, so one thing over here is I'm going to be debiting due from the factor, and this is going to be the holdback amount. I'm also going to be crediting because I have a recourse obligation, meaning if it defaults, I have to basically make the buyer whole. I'm going to have a recourse liability. Lastly, on this part here is I'm going to have a loss on sale of receivables. Now, when I have a loss on sale of receivables, what this is going to be is the finance charge plus my recourse liability. So this is the general journal entry I follow, and you can pretty much use this for every single one to record sale for E7-21, to record sale or record factor of receivables. Okay, so what we're going to do here is let's figure out, so we know that the amount of the receivables that we're selling is $25,000. We also know that the recourse obligation is $1,200. But let's figure out how much cash we're going to get. So if our accounts receivable is at $25,000, there's going to be a holdback, which is the probable adjustments. Okay, so this is right here is what we're going to call the due from factor. And then at the same time, there's going to be a finance charge. The finance charge is going to be 4% of the $25,000. Or $1,000. So my net cash received as a result is going to be $25,000 minus the holdback minus the finance charge, or a total of $22,750. Now, as we sit over here, so I have a liability. I'm going to record that liability with a credit, right? I need to take the AR off of my books. And so if I'm adding this up right now, I get this difference here of 2,200. What is this 2,200 made of? It is going to be the recourse liability of 1,200 plus the finance charge over here of $1,000. So I'm going to have a loss on sale of receivables of $2,200. And just to make sure that I did this correct, I want to go through and add up my total debits and credits to make sure these add up. And I would need over here date. Okay. So I'm not going to do part B, but I do want to give you more exposure to how do you handle a sale with recourse, a sale without recourse, because you're going to see it on your test. So thank you so much for joining me here today on this analysis of receivables, and I will talk to you soon. Have a great one.